The September quarter saw volatile global markets, with the highlight being the resurgence of China at quarter end. The MSCI All Country World Index in Aussie dollar terms was up 2.6%, and Founders Global Fund was up 8.1% for the quarter. China is in focus at the moment, with much of the global investment community being underexposed here. During the quarter, the Chinese market had single-digit PE valuations, double-digit earnings growth, and most importantly, at quarter end, we now have an aggressive round of financial stimulus that global investors have been eagerly waiting for. Essentially, we potentially now have a policy put on the Chinese stock market. The fund is well exposed to a recovery in China and owns a collection of well-positioned, founder-led stocks with strong balance sheets and attractive governance structures. If we see a sustained improvement in the Chinese economy post this stimulus, we expect strong returns to continue with these stocks. Our average total rate of return estimate for the Chinese portion of our portfolio remains above 20% per annum for the next 5 years. Okay, back to quarterly performance. Key outperformers for the fund during the quarter were Tesla and Palantir, which contributed 3.5% and 2.8% respectively. The largest underperformer was our Ethereum ETF, which detracted 2.5% from fund's performance. Running through these in a little more detail, Tesla's stock was up 32% for the quarter, predominantly driven by strong June quarter deliveries released in early July. Eyes remain on their October 10 Robotaxi unveil event for more details on their software and hardware footing in autonomous driving. We believe this segment will form the majority of Tesla's stock value over the long term. Palantir's stock was up 47% for the quarter. It reached the auspicious milestone of being added to the S&P 500, but more importantly, we saw a shift in the consensus narrative around Palantir's business model from being a tech consulting business to a monopoly software as a service, SaaS, business with no strong competition. This is important because the valuation multiple you pay for a tech consulting business, or more commonly called a labor hire business, is low compared to a monopoly SaaS product. This is because if you're a labor hire business, you can only really earn a small margin on top of the average wage you're renting your employees out at, and your business is seen as not very defensible or high quality. The misunderstanding or misclassification here lay in the broader point that when you are dealing with strong founder-led businesses, their substance can often not conform with established operating models. In a sense, they are creating something new. This makes valuation and classification difficult and prone to these errors if you don't dive into the founder and company culture. In this case, Palantir developed a quirky culture of being extremely outcome focused versus their SaaS competitors. To this end, they would send out what they called FDEs, forward deployed software engineers, to their clients to learn deeply about their problems and about how they could refine Palantir's core product to be as helpful and high impact for them as possible. But this kind of in the field or hands-on approach was unheard of at this scale for a SaaS business and gave rise to the narrative that Palantir was at its core a labor hire business and was only making money by sending out their employees to their customers and charging them out for a small margin. There was a lack of understanding about what Palantir was doing here from a technical perspective, but the main error was the assumption that because Palantir spent the time to deeply understand their customers' needs, it was a low quality or low margin business, when in fact the opposite was true. This question of low or high margin business has largely been put to bed with a more mature Palantir now printing industry-leading software implementation times, industry-leading client cost savings, industry-leading client growth, and rapidly expanding margins. So in short, Palantir had a unique focus on solving big problems for their clients. They went about it a different way to others and were penalized for it in the stock market. They did not conform to the classic operating model, but there was an opportunity as an investor to look through this by pairing financial analysis with a cultural assessment to see the underlying value of the stock. Since its lows last year, Palantir's stock is now up 6x. Our Ethereum ETF was down 24% over the quarter. The decline was during the first two months of the quarter. We discussed this in our last monthly update last month, if that's of interest to you. We continue to see Ethereum's large reduction in transaction costs as a very attractive medium-term setup for the protocol.